Ever wonder how the financial health of the globally renowned fast food chain McDonald's stacks up? Today, we're going to delve deep into the financials of this fast food giant, covering three key areas: liquidity, solvency, and profitability. First up is liquidity, which gives us a peek into McDonald's ability to meet its short-term obligations. The company's working capital and current ratio are indicators that it can comfortably cover current liabilities. This means McDonald's has ample resources to meet its immediate financial obligations, a sign of good financial health. However, a closer look at the acid test ratio suggests there's room for improvement when it comes to readily available cash. This is an area that warrants attention as it indicates the ability to pay off short-term liabilities without selling inventory. Moving on to solvency, which is all about the company's long-term financial stability. Here, the picture is slightly mixed. Debt levels at McDonald's are moderate, but the reliance on debt financing is inching closer to levels that might raise an eyebrow. However, it's not all concerning news on the solvency front. McDonald's boasts a decent equity presence and efficient leverage, helping maintain overall solvency. This means the company is not overly reliant on borrowed money and has a good balance of debt and equity financing. Finally, we arrive at profitability, the real litmus test of any business. This is where McDonald's truly shines. The company's strong return on sales, assets, and equity ratios are a testament to its operational efficiency and the healthy returns it offers its shareholders. McDonald's has a knack for converting sales into profits and leveraging its resources for maximum gain. In summary, McDonald's exhibits financial strength across key areas. While there are aspects that invite cautious monitoring, particularly in terms of debt and readily available cash, the overall picture is quite positive. McDonald's stands as a financially well-positioned company with efficient operations and strong shareholder returns. This assessment underscores the importance of these three core financial areas: liquidity, solvency, and profitability in evaluating a company's financial health. McDonald's serves as a prime example of how balancing these elements can contribute to overall financial stability and success.
Ever wondered how McDonald's maintains its financial stability? Well, you're in for a treat. Today, we're delving into the financial performance of this fast food giant, comparing it with others in the industry. First, let's talk about financials. McDonald's showcases balanced growth, and it's not by accident. A consistent rise in current assets points to successful business expansion and efficient practices. Look deeper, and you'll find investments in affiliates or intangible assets like goodwill. This is a clear indication of a long-term vision. Now take a stroll through McDonald's property and equipment portfolio. You'll find substantial growth, a testament to the company's emphasis on infrastructure. Depreciation does take a bite out of this gain, but it's a necessary part of the business cycle. What about liabilities, you ask? Well, McDonald's has those well under control. Shareholders' equity is the real star, dominating the financial structure. Altogether, McDonald's paints a picture of prudent growth, strategic investment, and financial stability. Moving on to profitability, McDonald's enjoys a strong revenue base, primarily from its company-owned restaurants. Rising food and paper costs are a reality, yet the company manages to maintain healthy operating and net income margins. And what's that on the horizon? Share repurchases. This move screams confidence in the future. Let's not forget about cash flow. McDonald's operating activities are flourishing, thanks to a robust net income and efficient working capital management. On the other hand, investing activities are a bit more cautious, with reduced capital expenditures. Financing activities exhibit significant fluctuations, suggesting strategic adjustments in debt and equity management. In comparison to other fast food chains, McDonald's financial performance stands out. Where many struggle to balance growth and profitability, McDonald's navigates these waters with ease. Their focus on infrastructure, strategic investments, and balanced growth sets them apart. To summarize, McDonald's demonstrates healthy financials, profitability, and dynamic cash flow management. This fast food behemoth isn't just flipping burgers. They're flipping financial strategies that solidify their position as a financially well-positioned company. So the next time you bite into a Big Mac, remember there's more to McDonald's than meets the eye. It's not just about the golden arches or the familiar logo. It's about a company that knows how to play the financial game. And play it well, they do.
McDonald's, a name that's become synonymous with fast food, has been steadily growing its financial assets over the years. This growth hasn't been a sprint, but rather a consistent, measured journey. The current assets have seen the most significant jump, with cash and equivalents initially soaring, before property and equipment took the lead as the most stable drivers of growth. Liabilities and shareholders' equity also saw a modest increase, with current liabilities rising the most due to a surge in short-term debt. Despite these ebbs and flows, McDonald's has maintained a balanced financial structure. Now let's shift the focus to some of the industry giants McDonald's competes with. Companies like Burger King and Wendy's have seen varied levels of success in the fast food industry. While they've had their moments of triumph, none have quite managed to mirror the steady growth McDonald's has experienced. The Golden Arches have remained a step ahead, demonstrating resilience and financial strength in a highly competitive and ever-changing market. Revenues for McDonald's have climbed at a moderate pace, with some volatility marking the operating income and net income. Despite these fluctuations, earnings per share and dividends have exhibited consistent growth. These ups and downs underscore the influence of operating costs and non-operating factors on McDonald's bottom line. McDonald's cash flow statement paints an interesting picture as well. Despite the fluctuations in net income, the cash flow has remained surprisingly stable. Operating activities consistently generated positive cash, supported by depreciation and amortization. Investment activities have been laser-focused on reinvesting in existing businesses, while financing activities saw share buybacks and increased dividends. This demonstrates McDonald's impressive ability to manage cash flow and prioritize long-term sustainability. In summary, McDonald's has experienced moderate growth in assets and equities, with some volatility in income and cash flow. However, their consistent cash generation and focus on shareholder value solidify their financial strength and resilience. While the fast food industry is a battlefield, McDonald's continues to stand tall, displaying a financial prowess that's hard to match. It's not just about the Big Macs and Happy Meals. It's about a company that knows how to manage its finances and deliver value to its shareholders in a way that few others can.
Why is growth and investment so critical to a company's success? The answer lies in a tale of a company that has managed to master the art of balancing growth, investment, profitability, efficiency, cash flow, and liquidity. Imagine a company that has seen a significant surge in its assets and revenue. This growth is not an accident or a happy coincidence. Instead, it's a result of strategic and calculated investments, primarily in property and equipment. These investments are likely for expansion or modernization, embodying the company's vision for long-term growth. Yet the company does not solely focus on long-term investments. It understands the importance of short-term liquidity to meet immediate needs and obligations, striking a harmonious balance between the two. The company's reliance on owner contributions, rather than debt, reflects a prudent financial strategy, minimizing risk while maximizing growth potential. The company's profitability story is just as compelling. Revenue flows primarily from company-operated restaurants, indicating successful expansion or performance improvements. Operating costs are high, reflecting the reality of the business environment. However, thanks to efficient management and relentless cost control efforts, the company not only sustains but thrives, generating solid operating and net income. While profitability is essential, the company recognizes that it's not the only measure of success. They maintain a mature and consistent financial standing, demonstrated by stable dividends and share count. Retained earnings are not merely hoarded, but reinvested back into the business, laying the groundwork for future growth and dividends. Now consider the company's expertise in managing cash flow and liquidity. It efficiently converts earnings into cash from operations, largely driven by depreciation and amortization. This reflects their investment in long-term assets, a testament to their vision of sustainable growth. Changes in working capital have minimal impact, indicating a well-oiled financial machine that can withstand the ebbs and flows of business. The company's financial strategy doesn't stop there. They invest heavily in property and equipment, ensuring the business is equipped for the future. They raise capital through debt and stock repurchases, diversifying their financial sources. Yet, they never lose sight of liquidity, maintaining an adequate level at year-end to meet any unforeseen needs. In summary, this company's financial performance is a masterclass in balancing growth and investment, profitability and efficiency, and cash flow and liquidity. It's a testament to the power of strategic financial management, showcasing how a company can thrive in a competitive business environment. This is the power of understanding and applying key financial principles to drive a company's success.
Ever pondered the financial muscle behind a global fast food giant like McDonald's? How does it stack up against its competitors in terms of financial performance? This video aims to delve into the financial intricacies of McDonald's and compare it with other industry players. McDonald's financial health can be described as stable growth. Assets and liabilities have seen a modest increase, with current assets remaining steady and net property and equipment consistently expanding. The steady increase in long-term debt, coupled with a slight growth in shareholder equity, hints at a controlled expansion strategy with a focus on infrastructure investment. When we look at profitability and revenue, there's a moderate growth. Interestingly, franchised restaurants are outperforming those operated by the company. Operating costs have declined, leading to an increase in operating income. Despite a significant decrease in dividends per share, net income and earnings per share have grown consistently. This could be indicative of a change in the company's capital allocation strategy. Now let's turn our attention to cash flow efficiency. While the net income has seen modest growth, the cash generated from operations has remained consistent. However, the fluctuations in working capital components and significant swings in financing activities suggest potential challenges in managing cash flow. This also points to a dynamic financial management strategy. Comparatively, McDonald's competitors show varied financial performances. Some have demonstrated aggressive expansion strategies, which have resulted in higher short-term gains but increased long-term debt. Others have shown more conservative growth, focusing on improving profitability and maintaining steady cash flow. However, none have matched McDonald's combination of steady profitability, controlled expansion, and dynamic financial management. Summing up, McDonald's boasts steady profitability, controlled expansion, and dynamic financial management. However, there may be room for improvement in managing cash flow and refining capital allocation. Compared to its competitors, McDonald's holds a unique position with its balanced approach to growth and profitability. Despite the challenges, the Golden Arches continue to stand strong in the fast food industry. So, next time you're munching on a Big Mac, remember, there's a whole world of financial strategy and performance behind every bite.
The tale begins in 2003, with McDonald's grappling with declining sales and market saturation. Negative publicity over health concerns linked to their traditional menu compounded the situation. However, the corporation was not to be daunted. Their response was a strategic shift towards healthier options. Salads, wraps, and fruit cups found their way onto the McDonald's menu, standing shoulder to shoulder with their iconic burgers and fries. Fast forward to 2008, the world is hit by an economic crisis. McDonald's, much like other businesses, felt the impact. However, in the face of adversity, the company demonstrated resilience. They adapted to the economic climate by implementing cost-cutting measures without compromising on customer satisfaction. The following years presented a new challenge as consumer preferences started to evolve. Customers demanded transparency and ethical practices from the companies they supported. McDonald's responded by improving its food safety measures and quality control. Labor practices were reformed and environmental initiatives were undertaken, contributing to a reduced ecological footprint. The dawn of the new decade in 2010 brought with it the rise of digitalization. McDonald's, not one to be left behind, embraced this change. They revamped their ordering systems and explored delivery options, catering to the changing habits of their customers. As we move into 2020, the world was hit by the COVID-19 pandemic. This global crisis demanded a swift operational shift towards delivery and takeout. McDonald's rose to the occasion, ensuring their survival in a world where dining in was rapidly becoming a thing of the past. Fast forward to 2023. Despite the strong performance, McDonald's faces challenges related to labor and commodity costs. The CEO warns of possible layoffs as the chain leans into fast service, innovation, and operational efficiencies. The goal is to continue to build on the company's growth strategy and eliminate silos within the organization. So what can we glean from this journey? The story of McDonald's Corporation is one of resilience, adaptation, and strategic decision-making. They face challenges in the form of market saturation, rising costs, changing consumer preferences, negative publicity, and economic disruptions. Their response was always strategic, whether it was menu diversification, cost-cutting measures, embracing digital channels, or operational shifts. However, the journey is not over. McDonald's continues to face ongoing challenges as they strive to balance affordability with profitability, keep up with evolving consumer demands, and stay competitive in a diversifying food market. In conclusion, McDonald's financial journey is a testament to the corporation's ability to navigate an ever-changing landscape while maintaining its position as a global fast food leader. The future will undoubtedly present new challenges, but if history is any indication, McDonald's will continue to adapt and evolve, demonstrating the resilience that has defined their journey so far.